All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Okay, good afternoon, everyone. Today is Thursday, September the 19th, 2023. Thank you, everyone, for joining us in this webinar today. The topic today we're going to be discussing is probably Canadians' favorite subject, and it's probably the one that Canadians overall invest the most in, basically real estate. We're going to be talking a bit about how real estate investing compares to investing in the equity markets overall. And we're just comparing and contrasting those two investments. My special guest today is Joseph Wu. He's the Vice President and Portfolio Manager of Multi-Asset Strategies. The agenda for today is Joseph's presentation is going to be approximately 30-odd minutes. And after that, we'll open up to Q&A, questions and answers at that point for about 10, 15 minutes. Many of you have already submitted some questions to me that I'll be asking Joseph at the very end. But as during the presentation, if there's any questions any one of you have for Joseph or myself, please feel free to email them to me. My email address is karim.visram@rbc.com. Again, email any of your questions you have during the presentation to karim.visram@rbc.com. Now, I want to take a minute or two to read out a little bio for Joseph before I pass the torch on to Joseph. Joseph began his career at RBC in 2007 and joined RBC Wealth Management Portfolio Advisory Group, or as we call PAG, in 2010, so about 14 odd years ago. He's a member of the RBC Wealth Management Global Portfolio Advisory Committee, which provides strategic analysis of financial markets and asset class recommendation to individuals like myself and everyone else in RBC Dominion Securities. Joseph also serves as the chair of the Global Portfolio Advisory Group's Asset Allocation Committee. He oversees the management and construction of the firm's multi-asset class portfolios. Joseph currently focuses on macro and multi-asset strategies, helping to develop and shape PAG's overall investment views and asset allocation strategy. He previously held positions providing research coverage in Canadian equities and exchange-traded funds. Joseph holds a Bachelor of Commerce from University of Toronto in Finance Specialty Program and is also a CFA charter holder. With that, let me pass it on to Joseph. Joseph, take it away.
Thanks for the kind introduction, Karim, and good afternoon, everyone. Let me just pull up some of the slides that I wanted to share with you today. Hopefully you're able to see that, and let me just make that in full screen. There we go. Again, thanks for giving me some time today to share with you some of our thoughts on the Canadian housing market. It's always a popular topic at dinner parties, which is an experience that I think many of you have likely encountered. I'll spend some time just talking about the historical returns of the Canadian stock market, what that looks like versus residential real estate, and also provide some thoughts on the outlook for the Canadian housing market in terms of prices, as well as in terms of supply and demand, the buyers and the sellers, in terms of sales activity and new listings. Of course, we'll reserve some time towards the end for questions if you have any. So with that, we're going to jump right into it. Starting with probably the most common question, the never-ending debate between for investors as far as whether the stock market or the real estate has been a better long-term investment. I think all of us have different experiences with homes and real estate markets and the stock market. So those experiences do play a critical role in shaping our views on this particular question. So our view here is, if you look at the historical data, it paints a pretty nuanced picture than what is commonly perceived. So I think for a lot of investors that may have invested heavily in real estate, they're looking at the stock market and saying, what's the point? But I think the first thing we need to acknowledge up front is that comparing real estate to the stock market does have a lot of pitfalls. But even with that in mind, our sense is that the simple analysis that you're looking at in front of you provides a few high-level key takeaways. So what we're looking at here is the performance of the TSX with dividends included and reinvested, and the performance of the national home price, assuming an initial investment of $300,000 with no leverage since early 1999. Some regional markets like Vancouver and Toronto have done a little bit better than the average, as you can see there in the green and the beige lines. The high-level takeaway is largely the same. Over the past 2+ decades, the stock market and the real estate market have both delivered pretty strong long-term returns. The stock market compounded at a rate of roughly 8%, and national home prices compounded at a rate of roughly 6.5% over the past 20+ years. Now, I think for those that are a little bit more detail-minded, here's a table that looks at trailing returns over the last 1, 2, 3, all the way up to the last 20 years, and since early 1999. So there is this timeless saying that location, location, and location. That's kind of the unique factor in real estate investing, and there's some truth to that. If you look at the housing market in Calgary, it's been pretty strong over the last 1, 2, and 3 years. In fact, a little bit better than the TSX over the last 3 years. And if you look at a market like Halifax, a smaller one nonetheless, that market has experienced some of the largest increases in home prices over the last 5 to 7 years. But I think in general, the observation that the Canadian stock market has more than kept pace with real estate across various local markets, that still holds true, and especially when you lengthen the time horizon out to the last 10, 15, 20 years. Now, I think...
Joseph, sorry, if I would interject here, and this is the Canadian stock market. If you were to compare against the U.S. or global, things may even look better for the equity markets. Is that because U.S. markets has significantly outperformed Canadian markets over the last same time period, 20-odd years?
Yeah, you know what? I would say that's mostly true over the last 10 years. I think the U.S. stock market has been exceptionally strong because you have a lot more tech companies in that market where you just don't have that in Canada. There's a lot more banks, a lot more energy, a lot more mining companies in Canada, and those companies haven't done as well as the Facebooks of the world or the Microsoft and the NVIDIAs of the world, which is exclusive to the U.S. market. So yes, if you look at the last 5 years, if you look at the last 10 years, the U.S. stock market has delivered very attractive returns. But if you go back to maybe February 1999, and we're cherry picking the starting point here. 1999 was just before the dot-com bubble bursted, which saw the U.S. stock market decline by almost 50%. Between 2000 and 2003. But if you go back to that period, the U.S. market has gone through a few pretty sizable bear markets. So since 1999, the Canadian and U.S. stock market has actually performed relatively in line. But yes, absolutely no argument. The U.S. stock market has done phenomenally well over the last 5 to 10 years, and certainly outpaced the vast majority, if not all, of the Canadian local real estate markets. And you also have to keep in mind, you also get the currency appreciation of the U.S. dollar. So the returns I'm showing you here for the S&P 500, that's actually U.S. dollars. And we know the U.S. dollar has appreciated in value over the last 5 to 10 years relative to the Canadian dollar.
Right.
Does that hopefully provide some perspective?
Yeah, for sure. Sorry, go ahead, Joseph.
Yeah, so as I mentioned at the start, it's generally not a great idea to compare real estate to stocks directly. It's pretty difficult. There's just a lot of factors that make a direct comparison challenging, if not outright misleading. As a start, for those who view real estate through the lens of investment, it's important to consider the need for liquidity and diversification. Real estate you can't really sell real estate very quickly for cash if you need it. So this lack of liquidity renders real estate generally unsuitable for investors that have needs for ongoing cash flow. And except for those that already have a lot of money, it's pretty hard to get a diversified real estate portfolio for any single individual investor. And if you kind of, on top of that, real estate also comes with potentially onerous barriers to entry. If you look at anything from down payments, you also need access to affordable mortgage financing and affordable insurance costs, which not everyone has access to, and all sorts of transaction costs that comes in terms of commissions, in terms of land transfer taxes, legal fees, and all sorts of things. And now, obviously, on top of that, you still have ongoing costs of maintenance, of maintaining a carrying cost for a real estate property. So if you look at property taxes, you look at repairs, you look at maintenance, you look at renovation expenses, these are all considerations that are often underappreciated when it comes to investing in a real estate property, because a lot of our emphasis, when we look at real estate, all of our focus is on the initial purchase price. Some of this extra cost, we just don't factor it in. So what you're looking at here is a table as an example of an estimate of what the monthly carrying cost would be associated with a property priced at just over $1 million, with a mortgage that's just over 5%, that's amortized over 25 years. And again, most of this prop purchase would be done with leverage, with mortgage debt. So right now, this monthly cost will come out to about $8,500 right now. You know, and as someone who lives in Toronto, I would argue that some of these numbers here are likely underestimating the actual cost. Utility costs in Toronto, for example, are very high these days. And as far as I'm concerned, in terms of property taxes and home insurance, these costs only ever go up over time, right? So I think this is just an estimate. It doesn't apply to every market, but for someone that lives in major markets like Vancouver and Toronto, the cost of these kinds of maintenance carrying costs for owning a real estate property would be significantly higher than for smaller real estate markets like Calgary and Edmonton and Halifax. Now, in contrast to real estate, it's typically much easier for investors to get exposure to the stock market in terms of requirements, in terms of transaction costs, in terms of being able to get a good level of diversification across different sectors, different industries, and different countries. It's just easier to get diversification in the stock market. And by the way, the stock market technically pays you over time, right? You get dividends, and the current dividend yield on the S&P TSX Composite is around 3%. Then that's about in line with the 15-year and 25-year average. So that maps out to about $30,000 in dividend income annually based on a static $1 million investment portfolio in the TSX today. So just to wrap up here with 3 takeaways, I think first, I obviously ignored some other important considerations. You know, I didn't touch on the impact of leverage, in this case, a mortgage, how that impacts potential returns for a real estate property. I'm also not accounting for differences in the taxation of capital gains. And I also didn't address the question of whether or not a primary residence should be viewed as an investment property. I would argue no, but I think broadly speaking, the view that both stock market and the real estate market have both generated strong returns over the long run, that's broadly a correct view. Second, we generally, advise against a direct comparison between the stock market and the real estate market. It's just it's a fairly flawed exercise for a number of reasons. All of us have different factors that matter more or less to us. So for the most part, it's just making sure that we understand the trade-offs and the differences between the two in a way that matters to you. And lastly, I think it's worth noting that investments in property, in a real estate property, and in the stock market are not mutually exclusive. You can have both as part of your investment portfolio. So a residential property can certainly play a role as a part of your overall portfolio. There's room for both stocks and real estate in your overall investment portfolio. So now I want to shift gears a little bit here to talk about the outlook for the Canadian real estate market. And we'll start with what is usually the most popular question, which is where are prices going? Again, this will vary from market to market. But nationally, after declining almost 3% last year, average home prices are expected to stage a recovery this year and next, even though RBC Economics currently forecasts a very modest recovery, with prices expected to rise only about 1% to 1.5% this year and next year. I think higher starting home prices in Ontario, which is the only other category, local market that I provide here, is expected to kind of push out that price recovery until next year. But this slow rebound should be viewed in the context of how much home prices have already increased over the last 10 years. At roughly 800,000 and 900,000, national and Ontario home prices are up roughly 65% and 75% since 2016. And since 2019, so just before the pandemic turbocharged home prices across Canada, prices are up roughly 45% over the last 4 years or so. So we've already seen a tremendous amount of price growth for real estate. So it wouldn't be very surprising to see kind of price growth moderate to some extent. And, you know, we'll come back to kind of the supply and demand factors, why the recovery is going to be slow at first. But we'll come back to that in a few slides here. But we want to start with on the supply side of things, because when you look at any kind of market, the supply and demand is the most critical input into price trend. So from the perspective of home buyers, there's actually some good news here on the supply front. Over the past year, the biggest trend that we've seen is a consistent flow of new listings into real estate markets. And you can see that here. Some of this reflects the fact that some homeowners are looking to offload properties where the cost of maintaining the property has gone up quite dramatically. But some of it does reflect newly completed residential properties, particularly condos. You have a lot of condos that have been completed over the last couple of years, and they're all coming online at the same time. The other trend that's very noticeable here is that sales activity remains very depressed in most regional markets, except for maybe Edmonton here, but we'll come back to that in a bit. So when you combine more listings and lower sales, or more simply put, more sellers and less buyers, what you get is inventories that have been rebuilding for some time. Outside of Edmonton, every major local market has seen a very significant increase in homes available for sale, which is what you're seeing here. At the national level, total home inventories are now the equivalent of roughly 4 months of sales, which is more than double the lows that we reached back in 2021. So what does this mean? It means buyers are under less pressure to act quickly. Those crazy stories of bidding wars are happening less and less frequently these days, simply because there are more options for buyers today. And the fact that home prices have flatlined over the past year further reduces any urgency that buyers, on the part of some potential buyers to jump into the market. So I think for the most part, we're seeing some really good news for potential buyers. And sticking with good news for buyers, we simplistically use the number of sales to new listings as a gauge for housing market conditions. Nationally, we're in the range of what RBC Economics would consider a balanced market. So at just over 0.5, this basically means there is currently roughly 1 sale for every 2 new listings that come onto the market. But again, if we go back to the golden rule of real estate location, location, and location, there are notable differences here between major local markets. From markets like Vancouver, Fraser Valley, which includes the Fraser Valley, which is where I used to live 20 years ago, and Toronto, the balance between supply and demand is now reaching a point that favors buyers. But on the other end of the spectrum, when you look at markets like Calgary, Edmonton, and Montreal, supply and demand conditions are still in either balanced or tight territory, which should offer relatively better price support for those local real estate markets in Calgary and Edmonton and in Montreal. Now, shifting our attention to the demand side of things, the Bank of Canada is now firmly in a rate cutting cycle. 2 weeks ago, we saw the central bank cut rates for the third meeting in a row. More cuts are coming. In fact, if we look at the left chart, which shows what markets have priced in terms of rate cuts through the middle of next year, it's possible that we could be looking at a policy rate that's close to 3% or another 125 basis points lower than where they are today at 4.25%. And if we look at the chart on the right, that's the bond market, specifically the Government of Canada 5-year bond yield, which is a rough proxy for where the 5-year fixed mortgage rate is going. That's already declined very significantly from the cycle peak of 4.32% in October of last year. They've already declined by more than 1.5 percentage points to under 2.75% as of now. So the bottom line here is that interest rates are heading lower, and this is positive news for home buyers that need financing. They're still really high for the most part, but they're a lot better than what they look like just 10 months ago. At the same time, despite financing conditions easing, we really haven't seen a very sustained pickup in home resale activity. So what you're looking at here on this slide is the number of monthly home resales. In July, this came in at just under 39,000 units. That is a lot better than the 33,000 units that we had in January of last year. But it's still 10-year average of around 43,000 units a month. I've highlighted the sales numbers here from March of 2021 and February of 2022, just to give you some perspective of how wild things got in the Canadian housing market during the pandemic years when interest rates went to zero and you could get a 5-year fixed mortgage rate for under 2%, and everyone was looking to move into the suburbs. You had 64,000 almost and 56,000 almost home sales per month in those 2 months during the pandemic. So things really got very wild for the Canadian housing market for a couple of years there. Now, as for why lower mortgage rates have not really encouraged more sales activity, the biggest reason is because affording to buy a home is still out of reach for many potential buyers. So what you're looking at here is RBC's housing affordability measure. This simply shows the proportion of median pre-tax household income that would be needed to cover mortgage payments, to cover property taxes, and to cover utilities based on current benchmark national home prices. And you're seeing it for detached, for condo apartments, but if you just focus on the orange line, which is the aggregate of all these categories, that includes semi-detached, includes townhouses, in addition to single detached houses and condos. The message here is that we're still near the worst level of affordability for many markets going back to the early 1990s. Now, the good news is that with prices having flatlined and expected to be relatively stable over the next year or so, and with mortgage rates coming down, we should see an improvement in affordability. But I think we need to manage our expectations a little bit because it's going to take more time to see more improvements to flow through to better affordability for home buyers over the next year or so. Now, with prices where they are today, becoming a homeowner is, it's just far more difficult since the pandemic. A lot more difficult for many first-time home buyers since the pandemic. So what you're looking at here is basically the price of admission into the housing market, if you will. This is the minimum down payment for a starter home in Canada. In other words, a condo. That's risen about 40% since 2019. The smallest amount a buyer can put down with an insured mortgage to purchase an average condo that's priced at, say, $575,000 is roughly $32,000. So that represents almost 40% of the annual pre-tax median household income for a typical household across Canada. Obviously, condo prices are cheaper elsewhere, but in Toronto, the average condo price is probably around that level. So when you layer on top of that a higher cost of living, which is something we've all experienced over the last few years, this just makes it even more challenging for first-time home buyers to save for a down payment, especially for the most expensive markets like Vancouver, like Toronto. Now, lastly, on the demand front, we also need to be mindful of that a lot of Canadian households already have a lot of debt. For every dollar of disposable income, Canadians owe roughly $1.75 in debt. And the average household in Canada is already spending about 15% of their disposable income towards servicing their debt, just paying the principal, paying the interest. So this is something to keep in mind. That's also it's also a factor that's suppressing demand on this front. Now, longer term, I do want to end on a more upbeat note here, at least from the perspective of home prices. Canada is one of a few major developed economies that should continue to see positive population growth. Now, with hindsight, we know that the pace of population growth over the last 2 years has been too strong. But I think at the end of the day, what we have in Canada is favorable demographics. Positive population growth should continue to provide support for home prices at the margin. Now, having said that, I think we also need to be mindful, in terms of making sure that we do have additional housing supply to come online over the next few years to meet this demand. We've had a housing shortage in Canada for a very long time now, and that's certainly played a role in driving some of the price growth that we've seen in real estate markets across Canada. So as much as existing homeowners and investors want to see the value of their properties rise over time, we also need to maybe think of it's equally as important to make sure that Canadians in general can actually afford to buy a home in the first place. Otherwise, prices could flatline for a while here. Now, I've rambled on for a while, so that's kind of where I'm going to wrap things up here. So this slide here just summarizes a lot of the key points that we covered off today about the performance of the Canadian stock market compared to the Canadian residential real estate market across different regions in Canada. So just some thoughts here I'll leave with you. So on that note, I'm happy to take any questions that you might have about the Canadian housing market or some of the things to consider between the stock market and the real estate market.
Okay. Well, thank you, Joseph. Thank you for a wonderful presentation. Please, and if anybody got any questions, I've got a bunch of questions here already that I'm going to sort of ask. But if anybody else has got any questions, please feel free to email them to me, which is at karim.visram@rbc.com. And before I sort of put out questions to Joseph, I want to stress that, by no means are we here recommending you do not invest in real estate. We just sort of, giving information as to there's a belief out there that real estate is the best investment. And Canadians have a love affair with real estate, which is wonderful. But there is alternatives, and equity markets. If you compare apples and apples, which is, as Joseph pointed out, if you were to leverage your equity portfolio, which we're not suggesting you do that, like we will leverage real estate. If you compare apples to apples, the equity markets compare very, very favorably with certain benefits to that. So again, Joseph, a couple of questions that have come in. I'll start with probably the easiest as the toughest. With the recent tax changes that came in with inclusion rate, going from 50 to 66% and stuff like that, does that change any analysis or anything, with this particular viewer saying that most real estate are generally held for much longer period of time? right? And with average real estate in Toronto or Vancouver, even a garage costs you $1 million, and an average, I'm not sure whether we have data on average holding period for real estate, but average holding period could be anywhere 10 years. So does that inclusion rate, do you think it may change or impact our views on different investments?
I think at a high level, it does not. We don't do any after-tax analysis here because the tax situation for everybody is for us to analyze in terms of the average growth rate, or sorry, the average tax rate for any particular investor. But I don't think the change in the inclusion rate matters very much. Whether you invest in the stock market or you have an investment property that's not your primary home, capital gains is still capital gains. So it doesn't really matter where that capital gains comes from. I think where you might see an impact, and there's been zero changes or zero discussion on that front, is the capital gains treatment of a primary residence. That if we were ever to the government were to ever look at that, and there are zero signs that they're looking at that at the moment anyways, that would maybe have an impact in terms of real estate versus the stock market. But as far as investment real estate property, capital gains and market capital gains, not a huge difference in terms of that. They're both taxed, they're essentially taxed the same.
Okay. I think this other one you've already addressed. Whether we largely compared Canadian real estate to Canadian equity markets, with one comparing to S&P 500. Would this analysis be different to compare, let's say, American real estate to S&P 500 or European, for example? Do we have any data? Anything? How does this compare to other parts of the world, other developed countries?
Yeah. So I think there are 2 points I want to make there. I think when you look at developed market stock markets, so Canada, Europe, and Japan, those are the biggest ones. For the most part, performance has been pretty similar over the last 20 to 25 years. I think where the story is maybe a little bit different is the U.S. stock market. Very clearly, the U.S. stock market has performed better than pretty much most other developed markets in the world, and that includes Canada, that includes most of Europe, and that certainly includes Japan as well. So the U.S. stock market has done better than the Canadian real estate market over the last 10 to 15 years. But that hasn't always been the case. We know that if we go back to, if you cherry pick your starting point to 1999, which is before the U.S. dot-com bubble bursted, it's a tie. They've delivered essentially the same returns. One is in U.S. dollar terms, and one is in Canadian dollar terms. So not apples to oranges, but performance-wise, they've been the same. But if you look at exclusively just over the last 10 to 15 years, yes, absolutely. I think the U.S. stock market has performed better than both the Canadian stock market, most other foreign markets out there as well as the Canadian real estate market. But we generally not a good idea to extrapolate performance forward. Correct. It's entirely possible that you see a little bit of mean reversion. Maybe the U.S. stock market doesn't do as well over the next 10 years. That's always possible. So, but I think if we just look at what's happened over the last 10 to 15 years, yes, that statement is true. The U.S. stock market has performed better.
Yeah. Thanks, Joseph, for that. A couple of other questions are coming in. Interest rates. We saw the Fed ease by a surprising 50 basis points yesterday. And so if you were to sort of look forward, I know we have our views as to where rates are going to go, what Bank of Canada is going to do its next meeting, and where Fed's going to do over the next 12 months or whatever. Jake, can you comment on what our views are, where interest rates are going, let's say 12 months from now, and what, if any, impact that may have both on the equity markets or, for that matter, real estate market? I know you've given us a forecast what the real estate market is going to do. But, if you can comment on what impact that may have on the stock market.
Yeah, I mean, we have a greater degree of conviction on the Canadian interest rate outlook. We know they're going lower. In fact, it's been going lower since June, right? That's not going to change. Inflation in Canada is basically back to the Bank of Canada's 2% target. The Canadian economy has slowed more than the U.S. economy. The unemployment rate in Canada has risen more than the U.S. And when you look at the balance of economic conditions in Canada, it's just simply weakened more relative to the U.S. So we have relatively high conviction that interest rates in Canada will continue to decline. And our expectation is that at every single Bank of Canada meeting over the next 6 to 10 months or so, the Bank of Canada is going to cut by 25 basis points. So by the summer of next year, interest rates, at least the Bank of Canada's short-term benchmark rate, is probably going to be around 3%. Currently, they're at 4.25. It's down from 5% at the peak. Now, if we look at the U.S. market, our conviction that interest rates are heading lower has improved. Our expectation is that interest rates will probably decline by at least 100 basis points, probably 150 basis points, if not more than that, for the U.S. So currently, the U.S. interest rate's at 5% after a 50 basis point reduction yesterday. By the summer of next year, and we should be looking at a U.S. short-term interest rate, the Federal Reserve over federal funds rate of probably around 3.5%, maybe as low as 3%. That view is based on the fact that we expect the unemployment rate in the U.S. to continue to rise. Also for consumer spending to slow just a touch in the U.S. as well. So in that scenario, I think there's a lot of room for both the central bank in Canada and the U.S. to cut interest rates. And, the inflation in the U.S. is running a little bit higher than Canada, but the direction is pretty clear. It's been heading lower for some time, and it will probably continue to head lower. So there's a lot of room for central banks to cut interest rates from current levels. Now, in terms of the impact on the housing market, I think you have affordability issues both in Canada and the U.S. So you do need to see more rate hikes happen before they start to flow through in terms of helping to improve affordability. So that's probably not going to happen for another 6 months or so. But the impact should be positive. It's just that the pace of improvement for the housing market is probably not going to be as fast as many of us expect. As far as the stock market, I think interest rates matter less than where earnings are going. I think for the most part, earnings growth is still positive. The stock market typically goes where earnings go over the long term. So as long as earnings are growing, and that's dependent on a growing economy, that should continue to provide fundamental support for stock markets. What would be more concerning for the stock market if we see material signs of a slowdown in the economy? And you're not really seeing that in the U.S. just yet. In Canada, you've seen a little bit more of that, but growth in Canada is still positive, and growth in the U.S. is solidly positive. So we're not seeing a ton of signs of any kind of recessionary conditions in Canada and the U.S. for that, but we're certainly keeping our eyes open, and that's certainly something we're paying more close attention to in recent quarters compared to last year.
Okay. Thank you, Joseph. It's got a last question, but if anybody's got any questions for Joseph or myself, please email them to me, karim.visram@rbc.com. Last question, Joseph. We compared sort of the broad Canadian stock market and the real estate market and stuff like that. And one listener's email is, how would this compare to the banking sector or financial sector? As opposed to the broad TSX 300, if you just compare it to the one financial sector, which is, the banks are very, very correlated to the Canadian economy, Canadian housing market. So would that, how would that comparison go? Real estate versus the financial sector.
Yeah, so I think if you isolate just the financial sector, or maybe just isolate the big six banks, performance, the key takeaways wouldn't change. The bank stocks, when you include the dividends, when you include them, or even better, if you reinvest them, you are looking at returns that are going to be very much comparable to the TSX composite, if not higher. Mm-hmm. I haven't looked at the data. I'm happy to kind of do the analysis and share with you. But my assumption is that you at the very least, it would have matched the performance of the TSX, if not beat the TSX. So the general conclusions wouldn't change. I think where the conclusion would change is the level of income you can expect. Canadian bank stocks usually yield more than the TSX, or if the TSX is yielding 3% right now and giving you about $30,000 a year on a $1 million portfolio, if you do that for the Canadian banks, it's probably closer to 4.5% right now on average. Mm-hmm. You're probably looking at a higher level of income from bank stocks. Some bank stocks are actually yielding more than 5% right now, but I think on average, it's probably around 4.5%, maybe just below that. So a higher level of income flow compared to the broader Canadian stock market. So on a total return basis, it will probably look a little bit better.
Yeah, that's what I thought. Well, thank you, Joseph. Thank you for a wonderful presentation. Thank you for everyone who joined us at this webinar. I hope you found it informative on this. One key message I wanted to leave before we end is, by no means we're recommending you do not invest in real estate. So I want to stress that, especially I think because of the taxation in Canada, investing in your own home, principal resident, is probably one of the best investments you can make in Canada because of the principal residence exemption. The analysis that Joseph has shared is more as real estate as an investment, not real estate in your own home. So just wanted to sort of stress that. And if anybody's got any questions following this, please feel free to forward them to me, and I can always forward it to Joseph. This webinar has been recorded, and we are hoping that we'll email it out to the listeners and everyone in the next week or 10 days. But in the meantime, if there's any questions, please let me know. Before closing, Joseph, thank you very much for your analysis. Thank you for your time. Thank you for all the hard work you did for preparing for this webinar. I really, really appreciate your time and all the assistance and chats that you and I have had over the last many years. So thank you for that, and thank you for everyone who dialed in. And have a wonderful rest of the day and rest of the week and the weekend ahead. Take care, everyone.
Have a good day, everyone.